Accounting principles. GAAP vs IFRS global financial reporting relies on established accounting frameworks. U.S. companies follow GAAP, generally accepted accounting principles, set by the FASB, while most other countries use IFRS, International Financial Reporting Standards, issued by the IASB. IFRS is adopted in about 168 jurisdictions worldwide. A key distinction is that GAAP tends to be rules-based whereas IFRS is principles-based. In practice this means IFRS provides broad guidance and requires more professional judgment, while GAAP contains detailed rules. Both systems share common objectives, such as relevance and faithful representation, but differ in application. The following sections review major accounting principles, definition, rationale, example, and how each is treated under GAAP and IFRS. Fundamental assumptions. Business, economic, entity assumption. Definition: the business's affairs are kept separate from its owner's affairs. Each reporting entity is a distinct economic unit, even if it has the same owners, e.g. a corporation versus its shareholders. Rationale: this ensures that financial statements reflect only the company's operations, avoiding confusion between personal and company transactions. Example: if a proprietor uses personal funds for a company purchase, the transaction is recorded as equity contribution, not personal income. Likewise, owner's personal car is not reported as a company asset. GAAP vs IFRS. Both GAAP and IFRS adopt this assumption, often called the reporting entity concept. There is no material difference in the treatment, each framework requires separate financial records for the entity. Note: consolidation rules under IFRS 10 and GAAP ASC 810 determine when to combine subsidiaries, but the business entity concept itself is common to both. Monetary unit assumption. Definition: only transactions measurable in money are recorded. This assumes a stable currency and excludes items like brand reputation or employee skill that cannot be quantified in currency. Rationale: using a monetary measure provides a common unit for valuation and comparability. It simplifies recording by excluding intangible or non-monetary exchanges that are difficult to quantify objectively. Example: an increase in customer loyalty or market share is not recorded since it isn't a precise currency amount. However, a cash investment or a loan, monetary items, are recognized. GAAP vs IFRS. Both GAAP and IFRS implicitly use a monetary unit assumption. GAAP calls it stable dollar assumption. Neither framework records non-quantifiable items. IFRS does not explicitly restate this assumption in its conceptual framework, but it is inherent in all measurement bases. In practice, this principle is treated the same under both GAAP and IFRS. Time period, periodicity, assumption. Definition: the entity's economic life can be divided into discrete time periods, e.g. fiscal years, quarters. Financial statements report performance and position over such standard periods. Rationale: dividing operations into periods allows investors and managers to assess performance periodically. Without this, results would only be shown upon liquidation, which would be of limited use for ongoing businesses. Example: a company closes its books monthly, generating interim financial statements, then a full year-end statement. Revenue earned in Q4 is reported in that period's income statement, even if cash is received later. GAAP vs IFRS. Both frameworks require periodic reporting, e.g. IAS 1 and ASC 270. The treatment is essentially the same. Financial results are allocated to defined periods. GAAP and IFRS both require interim, quarterly, and annual reports. There is no substantive conceptual difference in this assumption. Going concern assumption. Definition: it is assumed the entity will continue operating for the foreseeable future without intent or necessity to liquidate. This underlying assumption means assets and liabilities are recorded on a going concern basis, not at liquidation value. Rationale: if an entity were to liquidate soon, its assets would be valued differently and certain expenses, like depreciation, would not be deferred. Assuming going concern allows accrual accounting, spreading costs and revenues over periods, and more meaningful future-based valuations. Example, a machine purchased for $100,000 is depreciated over its useful life, not written off immediately, because the business is expected to use it for years. If a firm's financial distress casts doubt on going concern, it would disclose that and possibly change accounting basis, e.g. to liquidation values. GAAP vs IFRS, both GAAP and IFRS presume going concern. IFRS's conceptual framework explicitly requires preparation of financial statements on that basis. Under US GAAP, ASC 20540 requires additional disclosure if substantial doubt exists about the entity's ability to continue. Overall, the principle is common to both, each assumes continuity unless evidence suggests otherwise. Differences are mostly in disclosure requirements, e.g. specific GAAP guidance on substantial doubt versus IFRS's more general expectation. Core principles of recognition and measurement: historical cost principle definition, assets, liabilities, and equity are initially recorded at the original transaction price, historical cost. This cost includes all expenses necessary to acquire the asset, purchase price, fees, taxes. Subsequent measurement of the asset often uses historical cost, adjusted for depreciation or impairment. Rationale: historical cost is objective and verifiable, based on actual exchange value. It provides reliability and avoids subjective revaluations. It is less prone to bias than current value, because it reflects a transaction price supported by documentation. Example, if a company pays $50,000 cash for delivery equipment, it records equipment at $50,000, plus any sales tax and delivery costs. Later market changes, e.g. price of similar equipment doubling, do not change this carrying value, unless an impairment loss is recorded. GAAP vs IFRS, both GAAP and IFRS recognize assets at historical cost initially. A notable divergence is IFRS's allowance for revaluation. Under IAS 16, companies may choose to revalue property, plant, and equipment, and certain intangibles, to fair value after initial recognition, whereas GAAP generally prohibits upward revaluations of long-lived assets. In practice, IFRS assets are often held at cost or revalued at management's election, while GAAP assets stay at cost less depreciation. For example, IFRS can show land at current market value, but GAAP shows it only at historical cost. Both systems require write-downs for impairment, but IFRS may allow reversal of impairments for some assets, whereas GAAP generally does not. These differences underscore that although both start at cost, IFRS measurement can be more flexible. Fair value measurement, current/market value. Definition: fair value is the price in an orderly transaction to sell an asset or transfer a liability at the measurement date. It reflects exit price from a market perspective. Fair value measurement is used for certain items, e.g. trading securities, investment properties, financial instruments. Rationale: fair value provides current, market-based information and can have predictive value, reflecting up-to-date expectations. It may better represent the economics of an item than outdated cost. However, it relies on market data or models and can introduce volatility. Example, a stock investment held as trading is reported at its market price on each balance sheet date, changes are recorded in income. Another example, under IFRS, an investment property can be carried at fair value with gains reported in profit or loss, as opposed to depreciated cost. GAAP vs IFRS, both standards define fair value almost identically. Under IFRS 13 and ASC 820, the fair value hierarchy and measurement techniques are very similar. In application, IFRS tends to use fair value more widely. For example, IFRS allows revaluation of PPE and requires fair value accounting for certain investment assets, whereas GAAP often limits fair value to financial assets/liabilities and rarely permits revaluation of long-lived operating assets. However, for items measured at fair value under both systems, like available for sale securities or derivatives, the underlying principles and disclosures are alike. Revenue recognition, accrual basis. Definition: revenue is recognized when control of promised goods or services is transferred to the customer, in an amount reflecting the consideration expected. This represents the accrual accounting approach, matching revenue to performance rather than cash receipt. IFRS 15 outlines a 5-step model to recognize revenue in this way. Rationale: recognizing revenue when earned, rather than when cash arrives, ensures that income is matched with the costs to generate it, providing a realistic measure of performance. It prevents distortion of profit by delaying or accelerating cash. Example: a software company that delivers licenses and support service recognizes the sales price allocated to the license when delivered, and recognizes support revenue over the support period, even if the customer pays upfront. Similarly, a long-term construction contract may recognize revenue over time as work is performed. GAAP vs IFRS, GAAP, ASC 606, and IFRS, IFRS 15, are largely converged on this principle. Both use a 5-step framework: identify contract, identify performance obligations, determine transaction price, allocate price, and recognize revenue when, or as, obligations are satisfied. In practice, revenue recognition under both is very similar. Minor differences remain. For example, IFRS has specific guidance on assessing collectibility and contract modifications, but the core concept is aligned. Thus, unlike pre-2018 rules, there is no major revenue recognition principle unique to GAAP or IFRS now. Matching, expense recognition, principle definition: expenses are recognized in the same period as the revenues they help generate. In accrual accounting, costs are matched to corresponding income. In other words, costs, expenses or losses, are recorded when they contribute to the earning of revenues. Rationale: matching ensures an accurate portrayal of profit. By tying costs to revenue, financial statements reflect the true margin of transactions. This prevents manipulation, e.g. deferring expenses to inflate current profit, and aligns with accrual-based revenue recognition. Example: a manufacturing company records the cost of raw materials, COGS, when the finished goods are sold, not when the materials were purchased. Depreciation is another example: the cost of equipment is allocated over its useful life, matching a portion of cost to each period of use. GAAP vs IFRS, GAAP explicitly emphasizes a matching principle, whereas IFRS does not use that specific term but achieves the same outcome through accrual rules. Under IFRS, an expense is recognized when it results in an outflow or consumption of economic benefits. For example, IAS 2 requires inventory costs to be expensed as COGS in the period of sale. In practice, both systems align. Expenses like COGS, depreciation, and prepaid costs are recognized in periods matching related revenues. There is no fundamental conflict in how matching is applied, as both frameworks follow accrual accounting. In some nuanced cases, IFRS and GAAP differed historically, e.g. percentage of completion vs completed contract for construction, but convergence has largely eliminated those differences. Conservatism, prudence, principle definition: under uncertainty, assets and income are not overstated, and liabilities and expenses are not understated. IFRS's conceptual framework defines prudence as caution in judgment so as not to overstate assets/income or understate liabilities/expenses. GAAP traditionally described a similar concept as conservatism, anticipating losses when probable, but gains only when realized. Rationale: Conservatism protects users from overly optimistic statements. By recognizing likely losses early and delaying recognition of gains, financial statements tend to be conservative. This mitigates risk of overstatement of financial health. Example, a company may record a warranty expense or bad debt provision as soon as a potential claim or doubtful receivable is identified, even if not certain, whereas it would wait for confirmation before recognizing a gain from a lawsuit. GAAP historically allowed creating secret reserves, understating net assets, for safety, though standards have curbed this practice. GAAP vs IFRS, both systems embrace cautious recognition, but IFRS explicitly avoids deliberate asymmetry. The 2018 IFRS conceptual framework reconceptualized prudence as ensuring neutrality, no bias, by avoiding overstatement of assets/income. In effect, IFRS requires recognition of losses immediately, for example, expected credit losses under IFRS 9, and permits reversal of impairments if value recovers. GAAP's conservatism generally prohibits writing up assets, once written down, cannot reverse, reflecting a more conservative bias. Thus, IFRS is sometimes viewed as less conservative, since it forbids hidden reserves, but still prudent. In sum, both prioritize caution, but IFRS codifies prudence as part of faithful representation, whereas GAAP's conservatism tradition focused on always erring on the side of understatement. Materiality principle definition: information is material if omitting, misstating, or obscuring it could influence the decisions of users. Materiality is entity-specific, both the size and nature of an item matter. It is a filter for disclosure. Only information with decision-useful impact need be included. Rationale: materiality prevents cluttering statements with insignificant data, focusing the user's attention on what truly matters. It relies on judgment: immaterial errors or omissions can be ignored or aggregated, whereas material ones must be reported. Example, rounding an expense by a few dollars is typically immaterial and need not be detailed, but a $1 million fraud is material and requires disclosure. A small company need not report disclosing every minor trial balance adjustment, while a large public company must disclose any item that could sway investor decisions. GAAP vs IFRS: the concept of materiality is essentially the same under GAAP and IFRS. Both define it in terms of influence on decisions. For instance, IFRS states materiality is an entity-specific aspect of relevance, and FASB Concept Statement No. 8 similarly ties materiality to influencing decisions. There is no strict quantitative threshold set by either, judgment is required. In practice, interpretations may vary slightly, e.g. SEC guidance for GAAP registrants versus general guidance under IAS 1, but the principle itself is consistent across standards. Consistency principle: comparability, definition: once an accounting method is chosen, it should be applied consistently over time to allow comparability. Users should be able to compare financials from period to period. Under GAAP this is often phrased as consistency principle. IFRS emphasizes comparability, which includes consistency. Rationale: consistency enhances the usefulness of financial information. If methods keep changing, trends and ratios become meaningless. When changes are necessary, e.g. switching depreciation methods, disclosure is required so users can adjust comparisons. Example, if a company switches from straight-line depreciation to accelerated depreciation, it must explain the change and often restate prior year figures. Without such consistency, trends in profit or asset values would be unreliable. GAAP vs IFRS: GAAP historically invoked a consistency principle. IFRS does not label a consistency principle, but IAS 8 requires consistency in policies and thorough disclosure of changes. In both frameworks, any change in accounting policy requires explanation and usually retrospective adjustment. IFRS places more emphasis on comparability as a qualitative characteristic, See conceptual framework, but the practical outcome is similar. Methods are stable over time unless justified and disclosed. There is no major conflict. Both GAAP and IFRS aim for comparability via consistency. Other key principles: full disclosure principle definition. All information that is relevant and material to understanding a company's financial position must be revealed in the financial statements and notes. This includes significant accounting policies, contingencies, risks, and events. Rationale: disclosure provides transparency. Users need a complete picture to make informed decisions. Concealing material information would mislead users. The principle ensures that financial statements show not just numbers but the context behind them. Example: a company facing a major lawsuit, possible large liability, must disclose the nature of the lawsuit, potential loss, and how the amount was estimated. Similarly, a change in inventory valuation method must be described in the notes. GAAP vs IFRS, both systems require exhaustive disclosure of material facts. GAAP has many specific disclosure requirements, e.g. ASC 450 for contingencies, ASC 815 for derivatives, whereas IFRS tends to state broad requirements, e.g. IAS 37, IAS 8. In practice, GAAP often prescribes more granular disclosure rules, while IFRS disclosure requirements are principle-based. For example, a GAAP checklist might explicitly list dozens of notes, whereas IFRS requires sufficient information to provide fair presentation. In a broad sense, GAAP historically required more prescriptive disclosures, but IFRS disclosures, such as those in IFRS 7, IFRS 13, are still extensive. The key is that both frameworks mandate that nothing material is omitted. Notably, IFRS's focus on relevance and faithful representation means disclosures must provide faithful insight into facts, even if not explicitly enumerated. Objectivity/neutrality, reliability, principle definition: accounting information should be based on objective evidence and free from bias. GAAP refers to reliability, objective support, while IFRS uses faithful representation, completeness, neutrality, freedom from error. These concepts ensure that financial data are credible. Rationale: users must trust that reported amounts are not manipulated by subjective estimates or personal opinion. Objective, verifiable data, e.g. market prices, invoices, enhance confidence. Neutrality means not choosing accounting treatments to favor one outcome. Example: inventory is counted and valued using documented cost records, objective evidence. Management cannot arbitrarily inflate revenue by aggressive timing. Estimates are based on disciplined methods, not optimism. GAAP vs IFRS, both frameworks emphasize reliable, unbiased reporting, though terminology differs. GAAP traditionally emphasized reliability and objectivity, supported by evidence, while IFRS focuses on faithful representation, including neutrality. In effect, IFRS subsumes reliability into the broader faithful representation. There is no practical conflict, both insist on factual backing for figures. The IFRS conceptual framework's mention of prudence can be seen as reinforcing neutrality, which complements GAAP's conservatism. In sum, neither side allows deliberately skewed data, both require transactions to be recorded consistently with their economic substance. Examples and comparative notes: inventory valuation, illustration: under both standards, inventory is recorded at the lower of cost or net realizable value. A key GAAP-IFRS divergence is that GAAP permits LIFO, last in, first out, in costing inventory, whereas IFRS prohibits LIFO. For example, a U.S. company using LIFO may report a lower taxable income than if using FIFO. IFRS companies must use FIFO or weighted average. Another difference: if inventory value recovers, e.g. market prices rise, GAAP prohibits writing inventory up to original cost, but IFRS allows reversals of write-downs, up to the amount of the original write-down. Research and development costs, GAAP requires that R&D costs be expensed as incurred. IFRS requires that research costs be expensed but allows development costs, once certain criteria are met, to be capitalized as an intangible asset. Thus, an R&D project where technical feasibility is established can be recorded as an asset under IFRS, while GAAP would expense it. This reflects the principle that under IFRS only future economic benefits justify capitalization. Asset revaluation, IFRS permits revaluation of fixed assets to fair value, through other comprehensive income, while GAAP generally does not. For example, land held for use can be revalued under IAS 16 but under GAAP remains at historical cost. In contrast, both frameworks allow financial assets, like trading securities, to be carried at fair value with changes through profit or loss. Throughout all principles, the underlying objective is the same: provide useful, decision-making information. For each principle, both GAAP and IFRS aim to achieve relevance, reliability, faithfulness, and comparability, even if their approaches differ in detail. By understanding these principles and how each framework applies them, students and professionals can interpret financial statements across different accounting regimes. Sources, definitions and rationale are drawn from authoritative frameworks and references, such as the IFRS Conceptual Framework and educational summaries. Practical differences are illustrated by examples from industry and guidance.